Hello and welcome to the December 16th edition of the Gold, Goats, and Guns Market Report. My name is Tom Luongo. We've got a lot to talk about today, but before we get started, I want to do a couple things, couple historical notes. So, multiple birthdays today. December 16th is an important day to me. So I'm going to hijack you for a couple minutes while we talk about this. So first thing, December 16th, 1928 was the day that Philip K. Dick was born. And Philip K. Dick, along with many of the with a couple of the major guiding lights of Austrian economics, mostly Murray Rothbard and certainly Mises, probably the most important intellectual figures in my life. I learned a lot from Phil's knee, even stuff that I did not realize I was learning when I learned them. I started reading Phil Dick when I was 13 or 12, 13, something like that, right about my daughter's age, so 13. So, and I didn't understand any of it, and I still don't understand much of it today, but I understand more of it today than I did then. Moreover, Beethoven was born on the 16th of December. It's actually a really important day. If you look up who's actually born on today, you'd be surprised at just the number of great people that were born today. And the longer history goes on, the more great people. There's only so many birthdays, right? So I happen to share a birthday with John Williams, so I'm good with that too, right? But the most important one from a political perspective is that it's also the anniversary of the Boston Tea Party. And then, of course, it's the 10th anniversary of the Ron Paul money bomb, which Rick Santelli immortalized with his great rant on CNBC about which is credited as the beginning of the Tea Party movement. It's a big deal, all of this, right? All of this stuff. So there's a lot going on here. And the 16th of December is kind of important. And as we look at where we are today, it's pretty obvious that a lot of inflection points are being reached right around now. So let's talk about Mike Pompeo's horrific speech on Thursday at the German Marshall Institute. I won't even look at my freaking monitor while he's up there because I can't stand looking at this fat bastard's face. He really, really annoys me. Like, I'm at that point where I'm like, this guy needs to not be Secretary of State. When Hillary Clinton was Secretary of State, I didn't know any better. I didn't care. And I'll be honest with you, I didn't. Now that I know what's going on, I can't do this anymore. Because the truth of the matter is, and I want you to understand where this is coming from, but I'm becoming the realization this is not like me falling off the wagon, black-pilled, all this stuff. This is stuff that I've been worried about from the beginning with Donald Trump. I've been worried about his blind spot when it came to Iran. I've been worried about his mercantilism, worried about all of those things. And for a long time, up until very recently, I was willing to trade his mercantilism for a rational foreign policy. And I think everybody in the rest of the world was as well. The Chinese, the Russians, the European, even Europe to a lesser degree. Certainly, most of Central Asia would be okay with, you guys want to run some kind of mercantilist thing where you need to bring some troops, you need to erect some barriers, trade barriers, and get your house in order to try and get your house in order and whatnot. Fine. That's fine. Just let's end all of the Pax Americana crap and let's start untangling some of these Gordian knots geopolitically that the previous 5 administrations have saddled you with. Let's do this. And then you can have that. And that's not good enough for Washington. It's not good enough for guys like Mike Pompeo. It's not good enough for guys like John Bolton. It's not good enough for Bill Kristol or the rest of them. They refuse to. They're so ideologically possessed. These people are worse than Alexandria Ocasio-Cortez. They're worse than Nancy Pelosi. Why? Because they have the power. Because they've guided foreign policy to this point for the last 40 years. Because they've raped, pillaged, and destroyed multiple countries over the last 40 years. And none of it is in America's best interests, which Donald Trump so eloquently talked about on the campaign trail. And I don't care if you want to make excuses for Trump or not, that he's under siege, that he can't do anything. 90% of his problems are his own fault. For one, not understanding the depth of the problem, and for two, not being willing to stand up and truly take the slings and arrows and really fight back. Not just fight back on his Twitter feed. Because when you mix all of this together, you wind up with a set of policies, and this is going to annoy a lot of you. You wind up with a set of policies that's actually worse. Because in the end, it's going to destroy the credibility in the minds of centrists, in the minds of, it's going to harden the left that they're right, that Marxism is the only way. They're going to make the intellectual, they're going to be able to run roughshod over what's left of the libertarian impulse in this country. They're going to decry populists as nothing but fascists and Nazis. I'm not saying it's all going to work, but it's going to, in the end, it's going to harden everything, and it's not going to heal anything. And I hope I'm wrong about this, but I want you to think about it. Pompeo's speech was a Trumpian veneer over the standard neocon playbook. It couldn't be any more American exceptionalism. America's great. We lead. No matter what we do, we can do no wrong. We're not the villains. This is all classic John Barth stuff. Man can do no wrong stuff. This is such ideological horseshit. And it's not good. And we're not supporting it. Or we shouldn't support it. I'm certainly not supporting it. I never have. The only good news from this coming out of this weekend right now is that the Yellow Vest movement has jumped the curb, as it were. It's now in Belgium, in the Netherlands, and Great Britain. I fully expect things to start I fully start people to start showing up in yellow vests at Salvini rallies in Italy, for Christ's sake. I'm almost tempted to don one myself and stand on a street corner. We're getting to that point. This is what's happening here, and I think that this is real. I think that the French government and the French deep state have worked really hard to try and discredit all of this by allowing violence to be stoked and the over-the-top response from the police and the rest of it. It's not good. It's not good. These people have twisted. The most generous I can be at this point, that these people have twisted Donald Trump's inherent patriotism into something very, very ugly. And it's far worse than we ever would have imagined. Now, I think it's time that we all come to the realization about that. All right, let's move on. Let's talk about gold real quick. Good. My Pompeo's off the screen. I can put my glasses back on. I can actually look at the charts. Okay. So, yeah, for those of you who don't know, I do this as a screen capture, right? So let's talk about gold. Now, earlier in the week, last week, this time, we were hoping for some short covering back up towards 1270. We didn't get that. And that should be a warning sign to everybody. We didn't get very much. Continually get these little pushes higher, slight moves where we break the previous high, but with not a lot of upside momentum. That's telling me that no one wants gold to rise. The shorts don't believe that there's a real rally here happening in gold, and the pronouncements from the central banks have been such that they've really done a good job of holding everything in place until the Fed meeting on Wednesday. And I really think that that's what we're looking at right here. That the markets in general are not sure what the Fed's going to do. I think we get to show you the Dow Jones chart. I think that the market is bracing for more deflation, not less. Meaning, I don't think the market is expecting much, if any, substantive dovishness from the Fed. So they got a relatively hawkish ECB, but let's be honest with you. Do you really think that Mario Draghi is going to end QE in any substantive way. That the minute the Italian bond yields really begin to burst to the upside again, that once he stops buying them, that he's going to have any control over the situation. I don't think so. Remember, all of this, everything that we're dealing with is predicated on the perceived infallibility of the central banks. So I am expecting Powell not to back off of a rate hike here. He's not going to give in to Trump here. He may do so in March, but he's not going to do so here in December. They're going to raise rates. Even though there's yield curve inversions, they're going to raise rates. They almost have to. Otherwise, they will lose their independence, the perceived independence, which they don't have. And, beginning of 2019 doesn't hurt to, continue to put the screws to Trump in the hopes that they can get rid of him, in the hopes that, he finally just, okay, fine. This is how you guys want to play it? I'm out of here. So the whole Michael Cohen thing and all this other stuff, we'll see what happens. I don't believe in any of that Q stuff. So there we are. The reversal percentage we have here is for a 2-bar reversal to this level here. And note there's a coin flip in both directions. So that's gold. It's pretty neutral across all time frames. So today I want to talk about the GAMCO Global Gold and Natural Resources Trust. It's a mouthful. It's a closed-end fund that it's a closed-end gold and oil fund that also does some options trading on the side in order to generate incomes. One of the things I like about this stock is that it's a high-yield play on gold. It's one of the very few that are out there. Problem, of course, is that a high-yield gold and oil closed-end fund in a bear market means that the stock price is going to continue to get gutted. And that's what we've been seeing happen. And as far as the double whammy for this year, remember that we had a rally in gold and oil in the first quarter of this year, and then gold rolled over, and then oil rolled over, and that's why the stock price has been falling consistently in the latter half of this year. I wouldn't put too much stock in this double bottom here. It is what it is. It's not like there's any real support here. You have to understand, you have to remember that 3/4 of the stocks in the S&P 500 follow the S&P 500. They follow the indexes. And we've talked about the insane volatility. We've talked about other things as well. The truth is that we had a bearish Friday close on the Dow, which I'll show you in a minute. And that doesn't portend getting out of this. Oil fundamentals are bearish. There's a global slowdown happening. Certainly, U.S. oil fundamentals are very bearish. At least they should be, because we're producing like mad. We can't get most of it to market. The E&P companies are, the oil field services companies are in trouble, and none of that is going to. I don't see that dynamic changing. Right? I think Trump's happy with oil at $50 a barrel and gas pushing down towards $2, and that's good. But the oil patch, the frac space can't really support $45 a barrel or $40 a barrel. So I don't know. A lot of cross currents in oil. I think Brent is probably better bid, and it still is. It's still running about a $10 premium to West Texas Intermediate. I think that'll continue to happen as Brent is demanded, frankly, in the coldest parts of the world, and it's already been a cold winter. So I expect that to continue. But global demand for oil is attenuating because we've got a global slowdown upon us, because we're at debt saturation. And the stronger dollar is not helping anything. It's putting serious upward pressure on emerging market corporate debt financing. It just is. And bank stocks around the world are in serious trouble. The U.S. bank stock index is bad. The European bank stock index is bad. Banks are feeling this. They're the ones who want interest rates to rise. They need net income margins to rise, net interest margins to rise. Sorry, they don't make any money off of that anymore. The spreads are too. They've been too fine. It's part of the reason why the Fed started raising rates. Also, obviously, once you do that, when you start being able to raise rates, you start being able to allow pension funds to start getting some positive yield. So that's what's going on here, and I think the Powell will most definitely raise. So what does this mean for GGN? It means that GGN is probably not going to rally unless there's a rally in gold, but even so, that'll be muted by continued weakness in oil. Now, the other side of the equation is that at some point, once we clear this backlog, once we clear the supply-demand mismatch, this is probably as bad as it gets. And if we're looking at a rally in gold next year, well, then we're going to see we should see a bounce in this price. So I'm going to show you the trend that I like with GGN long term, and this is a closed-end fund, not an open-end fund. A closed-end fund means they raise X amount of capital, and that's all there is. There's a fixed float, right? They can't add more capital to the fund. So what's important here is understand that that distributions off of a closed-end fund, very similar to an MLP, though get categorized differently depending on where that distribution came from, and what the managers do is tell you where your distribution came from. So in the height of the bear market, it all came from return on capital. Return on capital means just like an MLP or Schedule 1 MLP, Schedule K1 MLP, the distribution you get isn't a dividend. It's a return of your original principal, and so therefore your cost basis is lowered, right? So if you bought it at $4 a share and you got 25 cents in dividends, or your actual cost basis is then $3.75 a share. Okay, when you go to sell, so you're not taxed up front on the gain or the loss, but you will be taxed when you sell, if you ever sell. So note, at the height of the bear market for both oil and gold, all return on capital. 2017, that started to improve. We started to get some long-term capital gains, i.e., appreciation in stock prices, along with some income. And then we got even more income. And then 2019, I'm expecting even more income in 2019, or most of this percentage in 2019 should be this, because the gold companies are improving their bottom lines, and certainly with higher prices. And the same thing with oil companies. So I expect 2019 to be pretty strong. These are announced dividends, so I'm expecting this is simply just first quarter dividends, not all of 2019, because we haven't seen a note from GGN that they're cutting the dividend by 80%. That's what that would represent. I don't see that happening. Market isn't that bad. So this fund went from paying 9 cents a month to paying 5 cents a month. That's where we are now. They paid 7 cents here. They paid roughly 5 cents here, and they should pay 5 cents a month here. That makes this a very attractive investment at these prices. For those of you who are at higher prices, I feel your pain, because we've had this in the portfolio for a long time. So that's the situation. I still like this trend. I still think this is the to look at. Now, this is a chart of the holdings, and I'm putting it up here. I'm going to leave it here for a couple minutes so you guys can go back and review it if you need to. But all of this information you can get from Morningstar. Just go to Morningstar.com, put in GGN, you can get all this information. So this is where I grabbed it from this morning. Note, excuse me, they've lightened that's the little minus sign here means they've lightened their load. The little plus sign means that they've added to their position. So you've noticed how they have been lightening their oil exposure and ramping up their gold exposure, other than Royal Dutch Shell, which is mostly a play on natural gas. So I like what management's been doing here. The fund manager is making the right choices here. He's buying the bottom of the gold market. He bought natural gas before it broke out, and he's getting rid of, in some ways, he's getting rid of exposure to some of the more exposed sectors in the oil space, or companies in the oil space. Overweight in ExxonMobil, he's brought that down. So this is fine. All this looks good to me. I don't have a real problem with this. So coming into 2019, if we are expecting a rally in gold, which is possible, it's not guaranteed. All depends on how long it takes for the European sovereign debt crisis to start burping up, right? It all matters, right? When we finally get the break point, is it going to be France? Is it going to be Italy? Is it going to be is there going to be Brexit? I mean, are they going to go to a hard Brexit at the end of March? It could happen. It's not high probability, but it's still on the table. So that's where we are with the holdings. I like what the portfolio looks like. That's where we are. So I'm still holding on to it for the Gold, Goats, and Guns portfolio. I'll continue to just reinvest dividends or reinvest distributions every month, especially since they're income, and I won't feel bad about it. And with a 2019 with a 2020 time horizon. So for those of you who are interested in that, and if you haven't bought a position in it yet, this is probably a good area to start accumulating a position. All right. So let's talk about the dollar. So it looks like we're starting to get this like consolidation here. The world doesn't want a stronger dollar. I don't think Trump wants a stronger dollar. I think everybody in the world is trying to jawbone a weaker dollar. Guess what? We still, even with this weird week, we still got a high that pushed above that more recent high. So higher lows, yeah, slightly higher highs, but still higher highs. There's still a moment where they can't keep the particle. They can't keep the particle inside the box, as it were. So this is the weekly chart. I showed you the quarterly chart the last time. If you haven't watched that video yet, go ahead and watch that one. Show you the quarterly chart of the U.S. dollar index. There, it's very crystal clear. The dollar is in an uptrend, and it's in a very strong uptrend. So, not much else to say about that. So, there it is. So, off of a bottom of 89, this is all just strong move upwards in the dollar, and I think that we're going to continue to see this coming into 2019, especially if the Fed raises rates on Friday. But the market at this point will. The market will listen to the numbers. We'll listen to the jawboning and then react to that. We may get some weakness. We can get strength. Also, that stuff. Never trust the initial reaction of the market to what happens. That's all the high frequency trading algorithms just going crazy based on the words. What will show up over the long haul will show up in the monthly and quarterly charts as to what's actually going on. All right, and then the last thing to look at, and this is the most disquieting thing of the month of the week, is that the Dow did not hold this very important level at 24,122.23. Did not hold. We closed at 24,100 and change. Bad. So that's implying that we're going to retest these other lows in here in the 23,000 area, 23.3, 23.2. Okay, and there could be some extreme weakness early in this week before the FOMC meeting. It all depends on the headlines. Don't look good coming out of this weekend. So, Chinese data looks terrible, right? Vancouver, we're seeing housing markets roll over, right? Debt market credit spreads are rolling, are going crazy. So it's like everything else. There comes a point until the confidence in the central banks is breached, until the confidence in the government systems breaks. Stocks are going to take it on the chin. Gold is going to take it on the chin. That's what happens. Until there's a shift in sentiment, until these people are revealed to be, inadequate to the task in front of them. And that's when everything goes haywire. So not sanguine about a bullish close on the Dow for the end of the month. At this point, you have to not be, but at the same time, I could also see a spike bottom on extreme sentiment. At which point, there's a stick saved by somebody, and we'll see what happens. All right, so that's what I've got for this week. I hope you guys don't take my comments about Trump being worse than Hillary out of the wrong context. I think it's really important that we review things carefully. Right. This is not a knee-jerk reaction on my part. This is something I've been very worried about for a long, long time, that he could do irreparable damage to the very people whose political fortunes he's trying to change. Okay. All right. You guys take care. You have a great Sunday. We'll talk soon. Keep your stick on the ice.